Hello, my name is Jonathan Petrie, and I'm going to show you my presentation on our Dow 30 analysis project. We analyzed the Dow Industrial Average in 2012 over the past 5 years from 2008 to 2012, and are trying to decide our personal favorite company to invest in. The first thing I did was create an efficient frontier. I figured that would be the best and easiest way of a starting point to pick my company. And as you can see, um, we use the standard deviation as our measure of risk and an average 5 year return um, for our return axis. As you can see, the efficient frontier relies on these top 3 points: the X, the red diamond, and the maroon diamond. Um, McDonald's is the X, and which is the company I chose because I'm a highly risk adverse investor. So I would want the most return for a given level of risk, and McDonald's is giving me that, being the lowest level of risk and giving me the highest return. The next thing showing you, I picked McDonald's. The next thing I looked at was, of course, as a possible shareholder, I want to see what's its return on equity, because I want to see if the managerial staff is maximizing my shareholder wealth. And looking at its return on equity in 2012 at 36.82, making McDonald's ranked fourth in the Dow 30, and showing from 2008 to 2012 a 22.33% growth and averaging a 5.31% annual growth each year. The managerial staff is obviously showing they are trying to maximize shareholder wealth and succeeding at it. But the next concern I would have is what is driving their ROE, because again, I'm a risk adverse investor. I do not want a highly leveraged firm. I do not want an equity multiplier driving my ROE. I'd rather have its sales and its income doing so. So the next thing I did was DuPont analysis, or ROE decomposition. Looking at its profit margin in 2012, McDonald's had 19.82, and it was showing a growth from 2008 of 8.11%. Total asset turnover is 0.8, and is actually showing from 2008 a slightly negative growth. And its equity multiplier, 2.31 in 2012, is kind of a mid-level multiplier in comparison to the rest of the Dow 30 companies. So obviously, showing from these numbers, the main component driving McDonald's higher ROE is its profit margin, which is good for me because I want my return being driven by their sales, their operations, their net income, and with its profit margin being so high, they are doing that. The managerial staff is doing that, and its operations are working well, which also includes the profit margin. These three aspects include the ROA, making McDonald's actually the number one ROA firm in the Dow 30 as of 2012. Next thing I wanted to see is its short-term and long-term solvency and liquidity to make sure that in the short run this firm is still operating and meeting their obligations, and in the long run still going to be around to give me that high return. So first I looked at the current ratio, 2012 1.4464, and showing a growth from 2008 of 4.36%, and it's averaging above 3% growth per year, meaning they are meeting their liabilities. They're actually increasing their current assets. So that is a good thing. They're showing in the short run they're solvent. They can meet their obligations. Next thing I looked at is the quick ratio, which is taken out of inventory, and showing actually McDonald's is decrease in their quick ratio, which I infer from the fact that obviously in the past years they're relying less on holding current assets and more investing in their inventory, which we can also see looking at its cash ratio. Its cash ratio has been dropping over the past few years, which is kind of counterindicative to the rest of the Dow 30 because of the high volatility of the economy these past few years. Many firms have been holding on to their cash, afraid to invest. But McDonald's isn't doing that. It's obviously using its cash from sales and investing in its inventory, which would make its cash ratio go down over the past few years and its quick ratio go down. So McDonald's is overall investing in its inventory. Next, I looked at long term. total debt to equity ratio, it has been growing over 5 years. So it's kind of a showing McDonald's is kind of in the long run increasing the reliability on creditors, which is not necessarily what I would like to see. But then I looked at their times interest earned ratio, or TIR, being in 2012 16.36. They're showing that they're meeting their growing reliance on debt. So they're showing as they are increasing their reliability in the long run from creditors, they're also meeting that 16.36 fold. So it's not really much of a concern to me as of right now. Next thing I looked at is, of course, their market value. Looking at their PE ratio in 2012, they're showing a 16.48, a 4.3 PE ratio, and which is a measure of their growth. And 16.43 is top 50 percentile of the Dow 30. Meaning, even though McDonald's, yes, is a large firm, it's still showing the ability for growth, a strong ability for growth, which is good for me. Next is the price to book at 5.78. This is coming from the fact that McDonald's is showing 5.78 times their market value compared to the book value, which I could infer from the fact that their PE ratio is so high and their ROE. The market is showing that is confident in McDonald's abilities. Next, I looked at their price. The stock price trading at the end of 2012 was $88.21, and using that, I calculated their expected 1-year return of 8.5%. I used doing the formula dividend discount model. I used the formula and calculated the expected price for the beginning of 2013 at $92.68, which tells me that the stock price is showing to grow. According to their numbers, their stock price should grow. And looking at currently, it's trading at 102.18. It's true. Their stock price is growing, and it's going to continue to grow. Next, I looked at decomposition of the EVA, economic value added, with a weighted average cost of capital of 7.5%. It's total invested capital growing over the past few years, and it's net operating profit, which is a good thing, growing over the past few years. EVA has been positive, and it's continued to grow for McDonald's, which is a good thing. It's showing the firm is creating value for the market and creating value for shareholders. And to show you how much it's been growing, their EVA has grown from 2008 to 2012 by 59.02%, which is an incredible growth in EVA. Albeit that in 2008 and 2009 we were in a recession, broke out of the recession, so every firm should be showing a growth in EVA. McDonald's has continued to grow in EVA at a substantial rate. So, in conclusion, I would say McDonald's is a solid choice for investing because they're showing a high level of return on equity. They're showing low levels of risk, and they're showing high potential for growth and continued growth, and the fact that they're going to be around here a long time. So that is my pick. Those are my reasons why I picked McDonald's as my favorite Dow 30 company.